The Federal Reserve Chairman announced the largest central bank rate increase since 1994. The rate of borrowing will increase 0.75%.
NBC7's Dave Summers spoke with a retirement investment specialist about what you can expect and what you might do with your money.
Add another increase to the cost of homes, cars, groceries, and gas. That is, if you need to borrow money to buy those things. Investment specialist John Iammarino tells NBC7 the news isn't all bad, but you might want to wait a while before you buy that next luxury item. Those tired of keeping close to home and a tight grip on their money because of the economic effects of the pandemic might do themselves a favor by staying the course.
If we're looking out for ourselves, we have to be mindful of what we're spending again. You know, as we've said in past interviews, Dave, control what you can control.
Investment specialist John Iammarino says the largest population affected by the increase may be credit card holders. Bankrate.com recently estimated the average credit card rate is 16.73%.
As soon as the central bank raises interest rates on banks, they're going to raise interest rates on their most credit-worthy people, and that's other banks, and credit cards fall into that category.
Iammarino says homeowners might pay off their credit cards with an equity line of credit, try to get a fixed rate, but even an adjustable rate will be lower.
My advice is for people to really shop around banks, credit unions, and see which one gives you the lowest rates.
Iammarino says increasing credit rates might lower San Diego home prices, but might also decrease the number of eligible buyers. Taking out an adjustable rate mortgage might not be the best solution.
The people that panic and go to cash because they're afraid.
How do we hedge this, right? How do we protect ourselves over the coming months?
That 401k, keep contributing, because now with every contribution you make into that 401k or Roth 401k or IRA or Roth IRA, you're buying those securities at a discount.
Iammarino says the Fed is trying to slow the economy to right inflation without destabilizing the markets. While 0.75% increase by most accounts is aggressive, the Fed isn't done yet.
The Fed said back earlier in the year that they plan on raising interest rates potentially 7 times this year. So we're not, we could just still be climbing that interest rate mountain right now.
Dave Summers, NBC7.
And during today's announcement, Fed Chairman Jerome Powell did suggest there might be a similar size increase as soon as next month.